Well, hello, financial accounting students. So this will be a brief video, just got 3 slides to cover. So let's get started. So let me start by sharing my screen. And let's go to our slides. So you may recall yesterday or Tuesday, when we started talking about long-lived assets, one way we split them up was between tangible and intangible. And we define tangible assets as those that have some physical presence to them, like land, buildings, or equipment. The other category is intangible, and these are assets that do not have such a feature. Okay. Within intangible assets, we're going to break it into 2 categories. So this slide, we're looking at that first category. These are assets that have identifiable useful lives. All right. So some examples here would be patents and copyrights. Right. So with these, we're going to treat these similar to the way we do with buildings and equipment. Conceptually, we're going to depreciate these. We use a different word than depreciation here. We use the phrase amortization instead of depreciation, but conceptually, it's the same idea. Okay. And with these types of assets, the ones that have these identifiable useful lives, we amortize over the shorter of the legal life or the useful life of the asset. So again, these assets, these ones with identifiable useful lives, come with a legal life established by the courts. So up top, we see patents might be 20 years, copyrights could be 120 years. So that would define this A, the legal life. That typically sets an upper limit. That's one possibility for how long we'd amortize an intangible asset over. The other option is the useful life. And this is a more practical measure of how long we think the benefit of having this intangible asset will really last. So while we may develop a patent and the courts give us a 20-year protection for that particular patent, the odds are quite high if it's a useful idea that you've come up with, other companies are going to soon follow suit. And that advantage that you came up with for this unique product or way of doing something probably is not going to last a full 20 years. So in reality, might only last 3 years or 5 years. That's what we call the useful life of the patent. And so we would amortize these sort of assets over the shorter of either the legal or the useful life. And we keep this straightforward. We just amortize these types of assets using straight line and assume no salvage value. So let's look at an example. So here's a company that bought a patent for a new computer chip from a small tech firm for $3 million cash. The patent gives Moon the exclusive right to produce the chip for 20 years. So there's the legal life. However, they expected the patent will only be valuable for 3 years. After that, new technology comes along, makes this patent worthless. Okay. So the first thing is record the purchase of the patent. All right. So let's look at that. So we debit patent. It's an asset. It's a long-lived asset. And we'll credit cash. So there's a straightforward transaction. Then let's record the adjusting entry at the end of the year to record the amortization expense. So again, we'll spread this over the short of the legal life, which is 20, or the useful life, which is 3. So we'll spread this $3 million over 3 years, or $1 million per year. So new expense here, first time we've seen this, it's called amortization expense. So we'll debit that for $1 million, and we'll credit accumulated amortization for $1 million. Okay. A couple things to note here in general. Sometimes companies, instead of using an accumulated amortization account, will actually credit the intangible asset itself. So you would see it both ways. And in this class, we'll make it appear as to be similar to the way we handle depreciation, and that we debited the depreciation expense, credited accumulated depreciation. So for amortization, we'll use that same approach. The other thing to note is, where does the cost for a patent come from? So in this case, we're buying the patent from another company. So that company had this patent. So how did that company measure the cost of that patent? Well, one thing to note is you can't make up your own value for how much you think a patent is worth to you. So when this other company, let's say they bought this patent from ABC Tech. So ABC Tech got this patent for a new computer chip, and on their books, that patent would be worth whatever it costs to acquire the patent. That's typically legal fees to file for the patent itself. So in their books, maybe the patent only is showing at a cost of $100,000. Because again, you can't make up your own value for how much you think your patent is worth, okay, when you first achieve that patent. So now we can see the patent was worth much more than 100,000, but so now our company, Moon, will put that patent down as 3 million because that is what we paid for it. So it makes sense. It's being, so again, the key takeaway there is the cost of a patent originally is typically the cost to file for the patent. After that, if you sell the patent, the company that's buying the patent will record the patent on their books at whatever the purchase price is. In this case, again, Moon is recording the cost of the patent at $3 million. Okay? Let's go look at the second category of intangible assets. These are those that have indefinite useful lives. So since it's an indefinite useful life, we can't amortize these. To amortize these, just like when we depreciate something, we have to have a useful life, a number of years, to spread the asset over. So with this category of assets, there is no useful life, so therefore we can't amortize these. So included in this category are items such as goodwill and trademarks. So let's take a look at goodwill. You spend some time looking at goodwill. All right. So here's our company. We're Salty Corp, and we just bought this restaurant, Bread and Wine, for $620,000 cash. So as part of this purchase of Bread and Wine, here's what we got. We bought their equipment, their building, and their land, and we measured their fair market value, okay? The FMV, fair market value. That's what that equipment is worth today at the time of the purchase. That equipment might be on Bread and Wine's books at 80,000 or 300,000. That's not what's relevant here. We're buying it today, and so in our books, we record it at what the asset is worth today when we're buying it. So refer to that as the fair market value. Okay. So what we're going to do, we're going to add up the fair market value of all the assets we acquired. In this case, 100, 450. So that's 550. We also took over some of their accounts payable. So that's a liability. So that creates what we call our net fair market value. Okay. The difference between the fair market value of our assets and the fair market value of our liabilities. So we come up with a total fair market or net fair market value, sometimes referred to as the net fair market value of our assets and liabilities, of 520. But notice we paid 620. Okay. So the question is, why would we pay more than the value of what we're getting? Again, all these things, again, are at their current value. It's not like you're saying, well, that equipment was really old and it's just not worth much. We're saying this is how much it's worth now, 100,000, and the building 400,000. Yet we're still paying this $100,000 premium. Okay, that's what goodwill is. So goodwill, first off, only comes about when one company is buying another company. So let's repeat that. The only way you'll ever see goodwill on a company's balance sheet as a long-lived asset is when that company has bought another company and they've paid more than the net fair market value of the company. So in this case, the net fair market value of the company is 520. We paid 620. That creates $100,000 of goodwill. And where'd that come from? The 620 minus the 520, 100,000 of what we're going to call goodwill. Okay. So the 620 minus the 520 gives us $100,000 of goodwill. All right. So let's do the journal entry for this. All right. So we'll record all the assets that we bought here. Right. Equipment, building, land. Right. We'll leave out the goodwill for a second so we can think of it as an item we're solving for with this journal entry. We paid 620,000 cash. We took over some accounts payable 30,000. So in order to make this journal entry balance, we need a debit of $100,000. That's our goodwill. We already knew that was going to be 100,000. So again, to calculate the amount of goodwill, it's equal to the price paid minus the net fair market value of what we've acquired. Okay. Now, what we have to do when we have to do it at least annually, okay, we have to test to see, did the goodwill become impaired? And so it's an estimate, right? So when we're buying this, ideally, if we're salty, we'd have preferred to just pay 520,000 for this company, right? But as part of the negotiation between Salty and Bread and Wine, they finally reached agreement that there was something special that wasn't captured in the net fair market value 520 that made Bread and Wine worth more than that number. So what could that be? It could be things like the reputation of the firm. That's not captured in the value of the building, the equipment, the land. It could be this amazing chef that they've got. It could be that every time we drive past it, there's an hour and a half wait. There's a line outside waiting to get in. Okay. It could be its location. There could be lots of things that factor in that aren't captured in just looking at the assets and liabilities that we've acquired and what those fair market values are. There's something above and beyond that. That's what's called goodwill. But it's an estimate. So we go back and forth this negotiation between Salty and Bread and Wine. They've set on 100,000. It's their best estimate of what that something special is worth. But later on, things may change. Okay. So let's say that maybe the reason we paid this extra $100,000 is because they had this chef that just won the Top Chef competition on TV. So the person's, they're a hot chef. They're on top of the cooking world. And Salty wants to buy this company and get access to this great chef. So they're willing to pay a premium for this extra $100,000. But let's say that after a year, the chef decides to leave. Do we say, well, now all of a sudden, the restaurant we don't think is worth that premium? It's still good. The customers continue to come, got a strong menu, just that the chef is gone. That was kind of important. So now we're saying that goodwill has been impaired. It's become worth less than we originally estimated by 40,000. So instead of having goodwill of 100,000, we only want it to be 60,000. So we need an adjusting entry to capture this. Okay. So the way we're going to do this, there's an impairment loss. We've seen this with inventory. We saw this on Tuesday when we sold a piece of equipment and we sold it for less than its book value. That created a loss. I'm sorry. We saw it the other day when we were looking at American Airlines, right? and its aircraft, the value of its aircraft had dipped below the book value of the aircraft. So as a result, we had to record an impairment loss to record that. So it's the same idea here, right? The asset is dipped below the value that's showing in our books. So we debit impairment loss, and here we credit the intangible asset, goodwill, directly, right? So now goodwill originally had 100,000 in it. Now we just credited for 40. So now it's down to $60,000 of goodwill. So that's an impairment loss with goodwill. So we need to test for that on an annual basis, or maybe as situations arise, if the chef walked out, 6 months into it, then we know there's circumstances have changed, and we're going to have to record this impairment loss. Okay. All right. So let's just look a little bit more at goodwill. So goodwill is fairly significant on many companies' balance sheet, roughly 9% of total assets represented by goodwill. This question is, are they always getting something good? So let's look at the sad case of Hewlett Packard, HP here, and some questionable acquisitions they've made over the years. Back in 2010, they bought Palm. So Palm was a company that developed this pretty cool technology known as the Palm Pilot. It was almost like a precursor to the iPhone, but it didn't have those communication capabilities. But it still was pretty awesome. I remember I always wanted one. Couldn't justify buying one, but so HP figured, handheld devices are where the future is at. Let's get in on this. So they decided to buy Palm. So they paid $1.2 billion for it, and in that $1.2 billion was a significant amount of goodwill. Okay. A year after they bought this, they realized in 2011, that's shortly after the iPhone came out, and the iPhone just made the Palm Pilot essentially worthless. You don't see anybody walking around today with a Palm Pilot, right? So as a result, that acquisition wasn't worth nearly as much as we had thought. So we had to record an impairment loss. In this case, it was $885 million, over 70% of the original purchase price. Right? A second one, EDS, Electronic Data Services, $13.9 billion acquisition. 4 years later, we look at this and we realize, it's not worth how much we paid for it. So we have to record a significant impairment loss. And one final one, Autonomy, was a foreign acquisition, software business. They paid $11 billion for, and here they wrote off 80% of it. So, and that was a case of lots of accounting fraud was going on at Autonomy. Wasn't discovered until after the acquisition. Found out, wow, the company's not worth nearly as much as we thought. Right? Collectively, look at the size of those write-offs. Right? They reduce shareholders' equity by 43%. So 43% reduction in shareholders' equity because of all these write-offs. So you talk about a significant hit to your books. This was certainly it. Measuring the amount of impairment is difficult. And if we were to go back, right, we talked about figuring out the amount of goodwill to pay. That's a challenge. Is this special something worth 80,000? Is it worth 120? Is it 90? Figuring out 100 is just a final negotiation that we've set it in on. Right? It's the best estimate at that time. Again, as we gain more experience after acquisition, we realize it wasn't worth what we paid. So now even more challenging is measuring the amount of the impairment. So measuring the amount of initial goodwill was challenging. Trying to figure out if there was an impairment, how much is perhaps even more challenging. Just a couple notes here. Market reaction to goodwill impairments. You can imagine it's not a good reaction, right? Particularly when the losses are larger than expected. Investors may have thought with this Palm Pilot acquisition, all right, a couple of years later, this iPhone's out here just dominating that product category, and that Palm acquisition is looking really bad, right? So maybe if they had estimated, look, they're probably going to write off half that amount, 600 million. They've built that into the stock price. And they find out it's almost 900 billion or 900 million. That may, cause the market to react even more negatively. Okay. That's the first thing. So markets don't react well to goodwill impairments, particularly if it's larger than they expected. Secondly, as a result of this, companies don't like to record goodwill impairments. How is it measured? It's one of the ways that companies do this. They try and estimate future cash flows associated with this acquisition, and discount these future cash flows back to the present, and still see is the company worth what we thought it was going to be worth. And if we start looking forward and the cash flows look like they're not going to be worth as much, then the present value of those cash flows might be below what we paid for it, and therefore there's going to be a goodwill impairment. What companies will potentially do, knowing that investors are looking at cash flows as a way to estimate, they're looking at present cash flows as a way to estimate what future cash flows will be, see if there might be an impairment. Companies might be tempted to sort of boost their current cash flows. Okay? And by doing so, it'll make it less likely that they'd have to record an impairment loss. Okay. Okay. So based on a sample of firms over this period here, it's right here. Firms suspected of postponing goodwill impairment losses. So it looked like, going back to HP, maybe we realized, look, they probably should have recorded a goodwill loss for that acquisition of Palm. Okay. But we don't see it. So it may be that, are they postponing that? They might show significant positive discretionary cash flows compared to various control groups. So somehow they've boosted their cash flows as a way of perhaps saying that, look, the future looks okay. We don't need to be recording any impairment loss when in fact perhaps they should be. Right? So bottom line, markets don't react well to goodwill impairments, and some companies might try to avoid recording those goodwill impairment losses by manipulating their cash flows that investors are looking at. Right? So that is it for this chapter. Right? So let me see if I can successfully end this.